Hi, I'm Jimmy. In this video, we're going to walk through the Shiller PE ratio. This is also known as the CAPE ratio. CAPE is short for a cyclically adjusted price to earnings ratio. The goal of this video is to understand what the Shiller PE ratio is, how it looks today, and how we could use it to make better investment decisions. Okay, let's jump right in. So this is a chart of the Shiller PE ratio going all the way back to 1920. And the theory here is that we can use the level of the Shiller PE ratio to determine if the market is overvalued or undervalued. And it's supposed to guide us as to whether or not returns over the next 10 years are supposed to be above average or below average. And we're supposed to be able to determine that based on the current level of the Shiller PE ratio. So how does it work? Well, if we think about the traditional price to earnings ratio, it's generally quite simple. We take the current price and we divide that by the earnings per share. Generally, those earnings per share are the earnings over the past 12 months. And that gives us the traditional price to earnings ratio. And ideally, we want to buy a stock when it has a lower PE ratio, since this would mean that we're paying a lower price for more earnings. So what the Shiller PE does is it takes the average earnings from the past 10 years and it uses that in the very same formula. So what it really does is it does a better job of eliminating the dramatic effects of any one quarter or one annual report. Another way to look at it is that this sort of smooths out the earnings. But the Shiller PE doesn't stop there. They took this one step further. They also adjust these earnings based on the inflation rate. So instead of 10 years of average earnings, they end up with 10 years of average real earnings. And just so we're all on the same page, whenever they put the word real before earnings or returns or anything like that, it's just a way of saying that that number has been adjusted for inflation. So if you told me that my return last year was 10% and that my real return last year was 8%, well, without you telling me any more information, I can safely assume that inflation was about 2% last year. So why does this matter for the PE ratio? Well, imagine a company was growing by the same 2% every year and pretend inflation was also 2% every year. Well, the company isn't really growing at all. They're really just letting inflation carry them along. So by adjusting earnings by inflation, well, we should end up with a cleaner look at their numbers and a cleaner look at the value they bring in the long run. So if we switch back to this chart, and just so we're clear, this is a chart of the S&P 500. Shiller has come out and said that he thinks this is best suited for the S&P 500. It's typically not applied to companies. You could do it, but most of the back testing has been applied to the S&P 500. So the assumption is that with the Shiller PE ratio, the S&P 500 will revert to the mean PE ratio, which basically means that eventually the ratios will fall back to the average. Robert Shiller's data, the man who created this index, well, his data went all the way back to 1871. And the average from 1871 till now is about 17, which is what this line right here is. And if you're curious where I got this information, I got it directly from Yale University's website, which is where Robert Shiller is a professor. And he updates that every month. The most recent up-to-date number that we have was as of December of 2019. I don't have January's numbers yet. So I just took that data straight from the Excel spreadsheet that he provided. Then I created these charts. So in theory, anything above this green line is supposed to indicate weaker performance over the next 10 years. Anything below the green line is supposed to indicate that there will be better performance over the next 10 years. Clearly, when the Shiller PE ratio got above 30 back here, this was back in 1929, well, if we were to zoom into the 20s and 30s, and then we would add the S&P 500 to this, well, the S&P 500 is the orange line. The blue bars are the Shiller PE ratio. Well, back when the S&P 500 was near its peak at this top of 1929, clearly the Shiller PE ratio was calling for huge underperformance over the next 10 years. And we know that because the Shiller PE ratio at that time was way above the average. And we could see that did in fact happen. Then when we jump forward the next 20 years, this is the 40s and 50s, well, here, the Shiller PE ratio spent much of their time below the long-term average. And if we bought the S&P 500 when the Shiller PE was below 10, well, the Shiller PE was correct. The next 10 years turned out to be quite true. Same is true back in 1950 going on to 1960. So clearly this is holding up. Now, if we jump forward again the next 20 years, if we bought down here when the Shiller PE ratio was high in 1966, well, we can see that it is once again true the investment would have underperformed. Now, that would have depended somewhat on what we bought or when exactly we bought and when exactly we sold. I sort of put it in a straight line here, but I think it's safe to say that we would have underperformed the average, knowing that in 10 years' time, we would have a 0% return. That sounds like an underperformance. Doesn't necessarily have to be a down performance. Okay, now this is where it gets interesting. Now we're jumping to the 80s and 90s, right up to the year 2000. Now clearly, if we bought in 1980, when the Shiller PE was low, below 10 in this case, well, the S&P 500 did in fact do great over the next 10 years, moved from about 200 to a bit more than 400. Sure, that doesn't look like a lot on this particular chart because of how high the scale actually went, but that's a double over 10 years, which is decent. Now it gets a bit more interesting. So in 1990, it seems that the Shiller PE ratio is right around the average level, and clearly the returns were anything but average. Now, if we're curious, Robert Shiller did his study of this particular, he introduced the Shiller PE ratio back around this time period when the Shiller PE ratio had just crossed above 30. And at that time, he said that this was the first time it was above 30 since 1929, and therefore he saw a crash coming in the not too distant future. And we can skip ahead to the next chart where we can see that he was right. That's what happened. That's when the tech bubble crashed. Now, a very high Shiller PE ratio at the start of the year 2000 led to poor performance over the next 10 years, partially in thanks to both the tech bubble and then the Great Recession. And a Shiller PE below our average line, which is what happened down here, well, we can see that this was the bottom of the Great Recession, and it did in fact lead to great performance over the next 10 years. But what about here? Well, the Shiller PE ratio was above the long-term average again, and clearly things have done quite well since 2010. So that's one of those examples where it hasn't exactly worked out that way. And we could see that since the Great Recession, the Shiller PE ratio has been consistently above the average. Now, we can't say with certainty that this means that the Shiller PE ratio is wrong. It is designed to give us long-term information, in theory, out 10 years plus. But the question that I found myself asking was, if we avoided investing whenever the Shiller PE ratio got above the long-term average, we would have missed out on the greatest bull run in history, at least in the United States. So in my mind, the Shiller PE ratio is a very useful tool. I don't think it's the end-all be-all. I don't think it's the final decision-making tool. It's a tool that we can use to perhaps consider how defensive we are with our investments. Even Robert Shiller has said that he chooses to focus on value investing and that he uses the CAPE ratio, which is the same as the Shiller ratio. Well, he uses the CAPE ratio to help him decide how over or undervalued the market really is at that particular time. Now, I do think it's important to point out that these numbers for the S&P 500 are price returns that don't include dividends. And dividends have proven to be better performers during a stock market crash and mostly in the aftermath of a stock market crash. They're generally the first stocks to recover. So if we're worried about a clearly high Shiller PE ratio right now, well, I recently did a video where I go through some good monthly dividend paying ETFs. And if you're curious, that could be a good next video to watch if you're looking for some good investments that could perhaps be good investments over the long term. I got a link right here. I got a link in the description below. And I want to thank you for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.